Ali is the creator of Zonda's proprietary indices, including the New Home Pending Sales Index and the New Home Lot Supply Index. She has focused much of her career on understanding prior recessions and led the charge on millennials, discussing millennials in the home building space. Highly regarded as an industry expert, Ali is quoted frequently in national publications, including CNBC, The Wall Street Journal, Forbes, Yahoo Finance, and has appeared on national and international TV and radio programs such as Bloomberg TV and Marketplace. Further, Ali serves as an advisor to the White House, providing data and insights on the U.S. housing market. It's Nix's pleasure to sponsor today's Sunbelt keynote presentation. Help me give a warm welcome to Ali Wolf.
Thank you, Josh, and hello, everyone. I am delighted to be here to go through Texas housing trends, our forecasts, and insights. Now, as mentioned, I am Ali Wolf, the Chief Economist with Zonda. If you're not overly familiar with Zonda, we are a housing data and consultancy firm. We track the entire building life cycle, from raw land all the way up to the closing out of new home communities. Now, our proprietary data at Zonda comes from the new home space. But we know to make sense of the market, we also have to look at what's happening in the existing home market, what's happening in the economy, what's happening with policy. So we're going to cover a little bit of all of that here today. Now, I have 40 minutes to go through 4 sections. The way you should think about this is we have about 10 minutes per section, where I'm going to start high level, look at the economic data. Then we'll talk about current housing trends and how that has evolved going through June. We'll talk about buyers. What buyers are active today? What buyers are struggling today? What are some of the demographics that are driving that? And then finally, we'll finish with our forecasts and final thoughts. So as we dive into the economic backdrop, we need to step back and go extremely high level. Look at what's happening with the labor market. And what we've seen is a surprisingly strong and an extremely resilient labor market across the U.S. economy. At the end of last year, think about some of the headlines you were seeing. There were a lot of announcements of layoffs that even went into the first quarter of this year. And yet so far now, we've had 6 months of strong job growth. National unemployment down to 3.6%. Now, as you look at the employment trends, I think there's one important thing to keep in mind, which is something that economists call labor hoarding. I've had some questions about why the unemployment rate has not gone up despite the Federal Reserve's best efforts. And part of this comes down to companies that are maybe seeing that their overall sales are down a little bit, but they're not entirely sure as to which direction the economy is going to go. So they're going slower at right-sizing their staff about making any kind of changes until they feel more confident. If you look at overall employment right now, nationally, we're 3% above where we were going into the pandemic. Here in Texas, 6% above. And I want that to be your takeaway as we go throughout these slides, as you see a very clear outperformance in most data sets of Texas compared to the national average. Now, here's your good example. The table and the map are showing the same thing, just different ways to visualize it. We know what's happening in terms of the short-term and the near-term employment activity, but what about longer-term trends? This is looking at employment growth from 2005 to 2021, basically the past 15 years. At the bottom, you see US, 0.9% annualized growth. And as you look at this list, you see so many of the markets here in Texas are outperforming what we're seeing nationally. Now, that's overall job growth. But we know as we think about the housing industry, we're also very interested in what's happening with high-income job growth. So nationally, high-income jobs are 6% above where we were going into the pandemic. Now, that 6% translates to 106 in the graph that I just put up here. So as you look at El Paso and as you look at Tyler, Texas, those are basically in line with the national average. But look at some of the other markets. Look at Austin. Look at Dallas. You've seen 20 to 30% growth in high-income jobs in 3 years' time. That is astonishing. That is higher than what we find in most markets across the country. So as you think about consumers, you think about people, the lifeblood of the economy, 70% of overall economic growth. They're looking around. They're seeing their wages are going up. They're seeing that if they lose their job, they could find another one quite quickly. They know that the economy is generally strong, but they are nervous. They're nervous about where the market might be going, and they're also trying to make sense of the fact that we have insistent inflation. Now, as we look at inflation, this has been the core problem in the economy over the past couple of years. A healthy, well-functioning economy should have an average of 2% inflation. And we got an excellent inflation report this week. We saw that headline inflation was down to just 3%. If you think about where we were last year, we were 3 times that level. Had I met with you this time last year, we would have been talking about 9% inflation. So 3% is a huge improvement, but that's a headline number. There's a lot of details behind that, and really the range is between 3 and 5% today. But 3 to 5% is still above the Federal Reserve's target. That's still high levels of inflation because that's price growth on top of already higher pricing. So you got to ask yourself, what's driving that inflation? Top 3 sectors: transportation services, our sector, shelter, and then food away from home. Now think about number 1 and number 3. Number 1 and number 3 are discretionary. You don't have to take that European vacation. You don't have to go out to that restaurant. If things got really tough, you could pull back on those 2. What you can't pull back on is having a roof over your head, on having shelter. And this is such an important part of the economy. If you look at inflation in general, our sector represents 43% of overall inflation. This is the key number that people are watching, and yet it is incredibly lagged. So the hope and the anticipation is that overall inflation is going to roll over because shelter inflation is going to roll over. It takes 12 months, usually, for a slowdown in real estate to show up in inflation data. That's why it's imperfect, too. But as we go into the next section, I'll get there in a few moments, know that we're celebrating that the housing industry looks so much better than expected. Policymakers are freaking out a little bit because it's important for them to see the housing industry and to see the rental market slow, because if it doesn't slow, inflation is going to remain high, it's going to remain persistent, and they're going to have to continue to be aggressive. Now, what does aggressive mean? The Federal Reserve has told us point blank, we are trying to slow the economy. Inflation is too hot. The labor market is too hot. We want to slow that down. And they've done their best efforts. Since last March, we've seen 10 short-term rate increases, trying to increase the cost of borrowing. Now, the key question is, some of you may have seen, in June, the Federal Reserve decided to pause or skip, depending on what their next move is. Now, this is important. We'll talk about how it relates to the housing market in just a few moments. But you have to ask yourself, what might be that next move? I feel with almost 100% confidence that the Federal Reserve will raise rates again this month. Now, as you think about that, what we have left is we have a rate increase in July, probably, maybe another pause or skip in September. Depending on how the data looks, November could be another increase. Now, there have been some economists that think the Federal Reserve is going to cut rates this year. Now, that's nice to think about, that's nice in theory, but you have to ask yourself, why would the Federal Reserve cut rates? They would cut it for one reason and one reason alone. The economy has slowed so dramatically and so desperately bad that it needs support, that they need to start lowering rates. We don't want to hope for the Federal Reserve to cut rates because they're seeing stuff in the data that's telling them they need to. Our base case, a few more increases, one, no more than 2, and then a pause throughout the rest of this year with some kind of cut possibly coming in 2024. Now, as you look at this, I think it's very easy to point blame at the Federal Reserve for making poor decisions. I've done it myself. But you also need to remember that the Federal Reserve is trying to make decisions on the economy based on lagged data. We already talked about that with shelter. And based on something that is very well known as the long and variable lag. This was established in the 1960s. We all think the Fed has raised rates. We know what that means for the economy. We've already seen the impact, when in fact we haven't. It usually takes time for those increases to filter throughout the economy. But as you look at all of that, and you say, okay, well, why does this apply to me? How does this apply to me? Why do I care? Well, the key answer is that is the single driver of housing affordability. What the Federal Reserve is doing, what's happening with the economy, what's happening with inflation, what's happening with consumer confidence and investor confidence is driving mortgage rates. That's why you care. That's why you want to know what's going on in the broader picture. Think about what happened. We said the Federal Reserve paused in June, and yet if you guys watch mortgage rates closely, you probably saw that they went up to 7% even after the Federal Reserve paused. That's because they're not the only driver of overall mortgage rates. There's all of these other factors. But the most important today is what we'll call market dysfunction, is that the fact that the mortgage-backed securities market is operating a little bit strange right now. And what that's doing is increasing the spread, the gap between two important numbers, the 10-year Treasury yield and the 30-year fixed-rate mortgage. Normally what you would do is pull up the 10-year Treasury yield, add 1.7 to it, and that would tell you where current mortgage rates are. That's a well-functioning market. But what we see during times of economic uncertainty, we saw this during the Great Financial Crisis, we saw this during the COVID changes, we're seeing it now. The spread has ballooned out. Now, why this is important is at least historically there has been a reversion to the mean, meaning you go back to that 1.7% spread over time. Our calculations is that you get back there within 12 to 24 months. That means if nothing else changed in the economy, we could be looking at mortgage rates in the 5s or the low 6s versus the high 6s and the low 7s that we're in today. So something we can look forward to, assuming history can continue to guide us, but doesn't change the reality of what's happening right now. When you look at existing home sales, both on a national basis and on a local basis here, spread across Texas, but also spread across most markets in the country, existing home sales are down year over year. Existing home sales are down compared to where they were in 2019. Now, they're down for a lot of reasons. Part of it is consumer confidence about the economy, about the housing market. Part of it has to do with mortgage rates and overall housing affordability. A lot of it has to do with housing inventory, where, again, if you look at listings on a national basis and spread across some of the top markets here locally, you do see that active listings are above where they were last year. Good, because last year was the depths of resale listings, so up from the bottom. But look at these numbers. You're seeing San Antonio to Houston down 20 to 40% compared to 2019. 2019 being this good, healthy year where even then we were saying inventory was tight. The only market here locally where we do have listings above 2019 would be Austin. And I think some of that is some of the exuberance that drove some investor purchases where they're trying to offload some of those homes. But it makes sense. If you own a home, 90% of people have their mortgage rate under 5%. 60% of people have their mortgage rate under 4%. They're saying, well, why would I want to sell? Why would I want to move right now? And this is where the building community has come in. So yes, we know that new home inventory is down compared to where we're coming from, but it's not down as dramatically as what we're seeing on the resale side. And as you look at the new home market, we have moved from 10 to 15% of overall inventory up to 30% of inventory. So someone is going around looking for a home, and they're saying, what's available? Well, they're finding a lot more new home options than they used to. And oh, by the way, the dynamics are a little bit more different as well. So think back. New homes are a luxury good. They have been, they always will be. You're buying something brand new. And historically, we've had a spread of 20%, meaning if someone was looking at a new versus an existing home, they should expect to spend 20% more money on a new home. Today, that spread is down to just 4%. Now, that spread is down nationally. That spread is very pronounced in Austin, in San Antonio, and Laredo. Now, as you look at this, the important thing here is that it's not that the same home is going to be less expensive. It's really indicative on how the market is changing, on how we're seeing there's some smaller homes, some homes being built further away. That's impacting that. But that doesn't change someone who's looking at the monthly payment, who's looking at what they can afford, and they're finding some of those options, and they're also finding some relative value. The resulting impact. When you look at sales, we have far outperformed expectations for this year. So this is looking at average sales rate per month per community. If a builder has homes to sell, how well are they selling? We adjust for supply. And this stands in direct contrast to what we saw in the existing home side. We have 2019, a healthy year for comparison. We have 2021, the height of the market, and we have current. Now notice, Dallas and Austin are above where they were in 2021. Think back to 2021. Those sales numbers are a bit skewed because we had builders that were intentionally capping sales. So it's a bit of an imperfect measure. My key thing here is as you're looking at these different markets, all of them outperforming where they were in 2019. Now let's understand why. We talked about having some of the inventory available. We talked about that relative value, but there's three key things that I think are very important to the new home market right now. Number one, builders can compete with the resale market by offering quick move-in homes. Some people like resale because they want to get in that home and they want to move soon. And that quick move-in home, a home that can be moved into within 90 days, serves almost as that direct comparison. Second, if you look at resale inventory today, we have opportunistic sellers that are trying to list their home at a really high price and aren't doing much to make it nicer. They're saying, oh, there's no competition, there's no other homes that are available, someone will buy it without me putting the work and effort into it. For discerning buyers, that doesn't work. If they're going to pay top dollar, they want a house that is nice, and that's where our to-be-built homes come in and offer an opportunity for those buyers. And I think most importantly, builders have the ability to work with the affordability challenge buyer. I got an email yesterday from a builder that said, we'll give up to $50,000 in closing costs. You're not seeing that in the resale market. Builders are offering, in a lot of cases, a mortgage rate buy-down that can get rates in the 5s. All of a sudden, that lock-in effect, why would I want to reset my interest rate? Well, if you're moving from 4 to 5, that's very different than if you're moving from 4 to 7. Each of those have helped support what we've seen in the new home market. But all of the data that we've seen to this point has been through May. And if you think about our industry, we are a seasonal industry. I know we lost some of that during the height of the pandemic years, but traditionally, February through May are the strongest months for the new home market. June is where you start to see some of that seasonality kick in. Now, we do a division president survey with builders across the country to say, hey, our data's through May. What are you telling us about what happened through June? Now, you're going to look at the bar is going to show you the height of the bar shows you the national, and then the text box shows you Texas. So 72% of the builders we're talking to for June said demand was on track with expectations. 28% said demand was slower. But it's not worrisome because this is the return of having some of that summer seasonality come back to the market. Now we can talk about summer seasonality, and yet there's another interesting dynamic going on where because there isn't that much competition, because builders have an advantage in today's market, they also retain some of their pricing power. So despite seeing a little bit of a shift in sales related to the time of year, most likely, we know that 54% of builders are still raising prices. Now that's on a national level. Here in Texas, it's 50%. 50% of builders are raising prices, 50% holding prices flat. But let's unpack that. When you think about price increases and you think back to 2021, we had a point where there was 97% of builders across the country raising prices. And they were raising prices $10,000, $20,000, $50,000. Now when we look at the price increases, we're seeing $1,000, $3,000, $5,000. We're having a lot of builders that we're talking to, that we're working with, we're saying, don't get over your skis. You were able to find the market, we've been able to capture this market share, but there also is this threshold with affordability that we need to be careful of and that we need to keep in the back of our minds. Especially when you look at the biggest hurdles related to demand. So number one nationally is current mortgage rates impacting affordability, number one in Texas as well. Number two here locally is people choosing to sit on the sidelines. People just saying, let me feel it out, let me wait, let me just see if there's more inventory that comes online. Third biggest hurdle related to demand should be no surprise, home prices. And as you look at what's happened to pricing, it looks so different today just compared to a few years ago. This is showing you top markets across the state. We're looking at new home and existing home price appreciation. And you can see, in almost every instance, we're looking at double-digit home price appreciation. And the resulting impact is overall housing affordability is going down. Makes so much sense. But as you look at the affordability ratios, notice that we have about between 30 and 50% here locally. Let me phrase it differently. Between 30 and 50% of households can afford the median priced home. That's down from where we're coming from, but that is exceptionally good on a national basis, which I think falls into the discussion of this market outperforming in a lot of trends what we're seeing on that more national level. But let's unpack that. Why are we seeing? So, okay, we have a better affordability ratio, but that's worse. That's double-digit, 30, 40% home price appreciation in a few years at the same time that people are earning more money, but inflation is up, and so their real wages are down, and this is all very confusing, especially with interest rates. Now, again, pretty close to 7%. So you got to ask yourself, why? Why are we seeing this outperformance? Why are buyers continuing to show up? Now, the number one reason is a lack of resale supply. We already went through that discussion point. But what about people relocating, having children, retiring, getting married, getting divorced? All of those fall into what we're calling the life happens housing market. That, yeah, we don't have as many investors today. We don't have as many flippers today. We don't have as many people buying because they're frenzied, because they're afraid they're going to miss out. That buyer pool has come down. There's no way to argue that. But what we're left with is structural demand. What we're left with are key reasons that people buy homes year in and year out. It's all of those life changes. It's I bought this home and darn it, I have a 4% interest rate, but I'm expecting my second child and this home doesn't work for me anymore. And maybe financially it's not the best decision, but for me and for my family, this is the right decision. So we can understand that, but you still have to get over some of those affordability challenges. And as we've talked about affordability, I've mentioned mortgage rates many times at this point. Mortgage rates don't impact every buyer equally. It's very easy to make a blanket statement, but then you have to dissect it. So as we look at this, some buyers are buying off of their salary. They're buying off of their W-2. And those buyers are going to be strained, no doubt about it. We're going to talk about them more later in this section. So the first half, I'll tell you, is going to be pretty rosy because I'm going to tell you all the different ways that people have been able to continue to purchase in today's market. But then we'll have a bit of a reality check as well. So as we think about this, other people, though, are buying off of other forms of wealth. Let's think about savings. Now let's go back to entering the great financial crisis. We had a personal savings rate of 2%. People were saving 2% of their income. So when things went bad, no doubt people didn't have rainy day funds. Let's exclude what happened during the pandemic, some of the high levels of savings, some of the low levels of savings. Let's look longer term. From 2010 to 2020, we had a 7% personal savings rate. People learned lessons. People started saving their money more compared to where we came from. And let's say that they invested that money in the stock market. S&P 500 up 60% in 5 years, up 170% in 10 years. So you save more money, you invested it, there's some found wealth there. Let's say you invested in real estate. When you look at home equity, Americans are sitting on a record $30 trillion in home equity today. The average household has gained $100,000 in equity just since the beginning of the pandemic. That's just since 2020. What about people that bought 5 years ago, 10 years ago, 15 years ago? What about people that bought 30 years ago? There are other people that have enjoyed much longer changes in what's happened with home prices. And in fact, some people have been in a place, either they've lived long enough in that home, or they've had some equity or other gains or other wealth that they've been able to pay off their mortgage. I think an amazing stat is that 42% of Americans do not have a mortgage. And when you look at how that's distributed, that's higher for those 55 plus. So you have people that aren't as concerned about interest rates because they don't have an interest rate that they're going to reset. And this has changed and impacted the dynamics of the housing market. From 2014 until 2021, the number one most active buyer in the housing market were the millennials. In 2022, that changed. Boomers became the number one most active buyer. Boomers became the number one most active seller. And think about life happens. What's happening? Retirement. People are retiring, and that causes that shift, that change. Do I want to live in this house? Is it too big for me? Do I want to live in the city? Do I want to move? That has contributed to some of the activity that maybe doesn't make sense, but it does. If you think about not having a mortgage and also having a lot of equity that's been gained. Now let's think about boomers from another way as well. So if you think about boomers, they're the second largest living generation, and they're the parents to the millennials, the number one largest living generation. Where yes, we have had millennials that have been buying homes, like we said, number one buyer since 2014. But for those that haven't, affordability is still such a key issue. And some people are lucky enough to have what we call the bank of mom and dad. 73% of boomers plan to give some or all of their money away while they're still alive, and think about how they gained some of their wealth in life. They understand the value of homeownership. They've been able to, in an environment where affordability is bad, in some cases help with that down payment, help to drive some of the sales. Now, not everyone is going to be blessed with the bank of mom and dad. I wasn't. But then you also have the bank of the government. You have a little bit of help that has happened since 2020. If you remember, student loans, all we did was talk about student loans in presentations going into the pandemic because, oh my gosh, people are putting $300, $400, $500 a month towards their student loan payments. They can't save for a down payment. That has been the key issue, the number one reason why people are saying they can't buy homes, younger people. They're saying, I can afford the monthly payment, I can't afford the down payment. Well then, starting in 2020, we had the government say, you don't need to pay those student loans for now. You're not going to get penalized. You're not going to accrue interest. You can save that money, or if you've lost your job, that can be a little bit of a help. That can be a little bit of a buffer. If you have people that retained their employment and used that money and put it in a savings account, here in Texas, that has resulted in a 5 to 7% down payment. In an environment where people said I couldn't save anything, all of a sudden, there's found down payment money. That has been a game changer for some. What about changes to the overall population? Now again, this is same as what we showed at the beginning of the presentation where the table and the map are showing the same thing, just visualized differently. You can see US, annual population growth over roughly the past 15 years, 0.8%. And then you can look at Texas. Almost every single one of those markets is outperforming that national level. Part of this is just due to natural growth. A lot of this is due to growth from migration. This is looking at domestic net migration. A positive number means more people moving in than moving out. A negative number means more people moving out than moving in. You can see most of the markets highlighted here have seen that positive migration, more people coming in. We know how work from home has transformed where people want to live, how people want to live, and we know Texas, for good or for bad, has been the home of where a lot of people have wanted to move. So this has been good for some people. This has been good for those people that have moved here, that have said, oh my gosh, this is so cheap relative to where I've come from, even after 40% home price appreciation. This is good for home builders. This is good for businesses that are looking for a bigger pool of people to potentially pull from to hire. It's bad for other people because we know that not everyone can tap equity from a higher area. We know that not everyone can say, oh my gosh, it's so affordable, when in fact we know that a lot of people are saying, oh my gosh, it's become so expensive. And it's become so expensive because if you just look at the median monthly payment compared to the beginning of last year, 60% increase. That's not going to work for a lot of people. So we can go through all of these great reasons, all these other sources of wealth and how certain people can continue to benefit, but there are a lot of people that are saying, how do I make this work? Am I going to buy a smaller home? Maybe. Am I going to stretch my budget? Not ideal, maybe. Am I going to look at other loan options? You can. You can look at more adjustable rates, and we're seeing some of those not become a big part of the population, but you're seeing a little bit of that. What about other options? Well, so much of our talk is about buying a new home. Yes, the new home premium has gone down, but it is still more expensive to buy a new home. Maybe you'll buy an existing home. Maybe you're going to rent. Maybe you're going to not be able to live by yourself anymore. Maybe inflation has pushed you high, rents have pushed you high, and you're going to have to move back in with friends or family. This is part of the reality that we have to look at, though, is yes, we can celebrate the wins, but also how do we make it work? How do we make the market work for that wider pool as well? So let's think about going into the existing home market. We said not many homes there. The homes that are there are generally expensive. Oh, and by the way, if you want turnkey, if you want a real nice home, you're going to pay a massive premium for that, maybe even more than buying a brand new home given the location. So someone who's looking to go into the existing home market for an affordability reason, well, maybe they're going to have to take a home that needs remodeled. I know you can't see this, but what it's telling you is 80% of people are willing to take a home that needs remodeled. Some people are enthusiastic about it. Some people are saying, I don't really want to, but if I can invest money slowly over time and actually get in and lock in that mortgage payment, then I'm okay with it. And that matches Todd Tamilak, our remodeling expert's belief that we are living through the golden decade of remodeling. He says we have a lot of people that have locked in that rate. We have a lot of homes, that's what this chart is showing, a lot of homes that are between 20 to 40 years old. He calls those homes within prime remodeling years. He thinks it's nothing but this upward growth with a little bit of risk to the economy, but generally this decade looks great for overall remodeling. Okay, so someone could buy a new home, they could buy a nice existing home, they could buy an existing home that needs some money, and maybe they can't buy it all. And what we've heard is, oh, these higher interest rates means all of a sudden everyone wants to go into a rental community. We don't think it's a flood of new people. We think it's that people cannot convert. It's a slower conversion from being in that rental community to becoming a buyer. And that conversion is challenging when you're looking at, this is showing you year-over-year change in rent and month-over-month change. Look at some of these markets. El Paso, Tyler, we're talking 7, 8% rent growth compared to last year. So not only are rents going up, but it's also becoming increasingly difficult to save for that down payment, which also makes it difficult to get out of that property. Now, as you look at the month over month, a little bit more of a mixed bag. And remember, think back to what we talked about at the beginning. We want to see. I know from a business point of view we don't want to see, but from an economic point of view, from a policy point of view, from having our policymakers chill out point of view, we want to see that the rental market is calming down. Now, as we go into our final 10 minutes of the presentation, I don't know if I mentioned, we will have questions afterwards. So you can either ask questions here live when we're done, or I'll be at Nix's booth and we can talk one-on-one if you have some things that you want to talk about. But keep that in mind that we will have questions in about 10 minutes. Let's go into our forecasts and final thoughts. So looking at all of this, I think what we understand is that more building can help. But that's so much easier said than done when you look at the constraints on building. Now, nationally, the biggest issue, government services. Second biggest issue, land. Then supply, and we look at supply as really building material availability, building material cost, and then 4, labor. When you look at this for Texas, I was amazed, astonished actually, that we only had 4% of the builders that we're talking to that are saying labor is significantly impacting their ability to get homes built. I think the thing is, it is impacting the ability, but it's reverted back to an environment that isn't as bad. It doesn't feel as nuts as it did during 2021, where everything was getting delayed and everything was getting pushed back. And I think labor in the grand scheme of things doesn't feel as bad as maybe government services. It doesn't feel as bad as some of the land challenges. Now, what do we mean about land? Now, if you look at land and you talk to builders and you say, what is your biggest worry? The number one biggest worry, land prices. The number 2, which corresponds perfectly with that, is new home affordability. Number 3, which corresponds perfectly with those first 2, is inflation. You can see what the key issues are. And luckily here, there are some markets that I go to where land does represent 50% of the final home price. That's not the case here, but we do know that land prices have gone up very dramatically, and they continue to, in some cases, go up. In other cases, they're flattening out. But they're flattening out at these elevated levels. So when we talk to builders and we say, what are you seeing with land prices? 70% here locally are saying that land prices have primarily flattened out. 21% said they're still going up. But they're still high, they're still elevated, and if it's a good piece of land in a good location, desirable, can make the deal work, it's also very competitive. When you look at what's happening with land acquisition, We have 35% of builders nationally that are full steam ahead. We have 45% here locally. There is so much enthusiasm, there was so much appetite to say, okay, let's plan for the future. Let's plan for all of these people that have moved here, for all of this pent-up demand, for the idea that we do know people want to ultimately become homeowners. But let's also recognize that that's going to be stop-go. What you're looking at here is total housing starts in the top 25 markets across the country. Dallas number 1, Houston number 2, Austin number 4, San Antonio number 6. Now, what you notice on this list of 25, this is for first quarter, every single market in the top 25, to no exception, had housing starts down in the first quarter on an annualized basis. Now, we're going to release our second quarter data in about 2 weeks. I suspect that we'll still be down, but that gap has narrowed quite significantly. We think that, and we know that, there has been more aggressive building as it has felt like, okay, this level of demand has felt a little bit more sustained than originally thought. But when you look at starts being down, I think our initial thought is, well, that's bad. Well, why does it have to be bad? It does because, in a way, we're not building as many homes, and we know that we're trying to fill that deficit, but we also know we were running 100 miles an hour. We had people that were burning out. We had a system that was broken. It couldn't keep up. And as we've seen starts go down, we've seen the return to some healthy cycle construction timelines. That's good. We're not seeing these consistent price increases. We're seeing a little bit better of that labor availability. Not good. I don't think it'll ever be good or perfect, but at least a little bit of an improvement. So as we think about the rest of this year, let's go back to the end of last. End of last year, we had these mortgage rates go up. We had the market that had gone down. We had headline risk. All the headlines were bad about the market. We had only 25% of builders that thought starts would be up this year compared to last year. Now, as of June, we have 50% of builders here locally that think starts will be up, 50% of builders that think starts will be down. Now, as you look at this, there's a big if to this. So there's more enthusiasm. Okay, we need to build more homes. Okay, this is the builder's time. Okay, we've gained this advantage. But there's the big if related to financing. Again, the reason we start with that economic update is because it filters through to our industry, and one of the most important and impactful things that we're watching is how does that filter in to financing costs. We weren't as concerned about this until the collapse of Silicon Valley Bank and all of the turmoil that we've seen in those regional banks and how that has resulted in tightening credit availability. This is looking at credit availability for acquisition, development, and construction loans. Black line, anything above, says that it's easing. It's a little bit easier to get access to credit. When it's below the black line, it's getting harder. You can see that throughout this year, especially that purple line, it's only gotten worse since we've seen some of the turmoil in the banks. So this is important. There may be enthusiasm to build more homes, but there may not be the financing behind it to allow that to happen. Now, that will depend, though, on what builder we're talking about. So larger publics, I'm not really concerned about their access to capital. When you look at this, it's showing you across those 4 main markets what has happened to public builder market share since 2010. You can see public builders are gaining market share. It's happening all across the country. We moved from about, I think, 25% of the market being publics nationally to now about 45%. So massive shift, not as bad, well, actually it is bad, isn't it? 70% as I look at that. In some of the markets, it's now 70% of the market goes from publics. So not concerned about that access to capital, not really concerned about the smaller privates, but we are, the larger privates, but we are a bit concerned about what that means for some of the smaller privates. So as we roll this all up, if you saw me present in Houston a few weeks ago, we have revised our forecast a little bit more positive since then. We have not touched our multifamily forecast because we actually think we're still too high at 410. But the numbers from the government show supportive high levels of multifamily. What we're hearing on the ground is multifamily has seized up, and it's seized up almost exclusively because of what I just talked about, access to capital, access to credit. We bumped our single-family number up, though, based on the sustained demand that we've seen, even with some of the seasonal change in overall activity, and based on some of the enthusiasm that we're hearing as we go across the country. But as we look at our forecast, so where we have is we expect starts to be down 10 to 15%. But we always do a check then. We say, okay, well, what could make us too positive? Well, as we look at this, we already said multifamily feels a little bit high. We're assuming some kind of improvement in affordability. We're assuming that that spread that we talked about earlier between the 10-year Treasury and the 30-year fixed-rate mortgage comes down a little bit. We see a little bit of an improvement on mortgage rates. We maybe see a little bit of improvement on home prices. If that doesn't happen, this forecast will be wrong. It'll be too positive. We're assuming a modest credit tightening. If it actually becomes severe, if it becomes more widespread, then this forecast is wrong. This forecast is too positive. But are we too negative? Are we too negative saying that starts are down 10 to 15%? Well, I already spent the majority of this presentation talking about how housing has been exceeding our expectations. And I was one of the first to say last year, when the market was slowing, this happens. Housing slows before the rest of the economy. Housing comes back before the rest of the economy. And so there is a chance that this upswing that we're in is part of this continued growth up, in which case our forecast may be a little bit too negative. But that's the question. Is that it? Have we lived through that housing recession? And yes, it's still a little bit hard. We still got to fight for the sales. Yes, it's not easy every day. It's not as strong as it was, but it's definitely an improvement from the depths of the market where we had to cut prices $50,000, $100,000 like we saw last year. Well, there's a few things that I'm watching. We're watching what's happening with Fed policy. We talked about the long and variable lag. It's something we can't ignore. It's something that in the 1960s they established. This is a well-known phenomenon, that it takes time for Fed policy to play in. And I bet no one in this room, myself included, knew the holdings of Silicon Valley Bank before March of this year. There are unknown risks that we don't know, that we're watching. We're watching consumer spending. We know that consumers are generally holding up, but remember what I said earlier, 70% of the overall economy. Federal Reserve wants to see it slow. Are they going to see it slow, or are they going to see it crash? As we have the student loan forbearance run off, it is good, in my opinion, that people are resuming making those payments on their student loan debt, but that does mean that money gets pulled out of the economy. Does that have an impact? We're going to watch that. The office market, I feel like enough said. There's just a lot of risks here related to vacancy, related to return to the market, related to the number of office loans that need to be refinanced, and they need to be refinanced at much higher rates today, and how does that work when we still have vacancy in many of the markets across the country. So what we're watching for would be some kind of double dip, where we have seen this upswing, we have seen this bit of a market gain, but if there are broader economic concerns, we're going to watch that very closely. We track the data, frankly, on a day-to-day basis to see how the trends are moving. But as we look at those risks, it would be ridiculous for me to come up here and pretend that those don't exist, because they do, and we need to watch them. But we also feel so exceptionally good about the housing backdrop, especially related to demand. Anyone that has followed my career, I've spent so much time focusing on millennials. When are they going to buy? When are they going to buy? Well, they've been buying homes forever, and now they bought their entry-level home that doesn't work, and now they're trying to figure out, what do I do next? There's demand there. There's people that are unhappy in their current home and waiting to see mortgages come down a little bit that maybe they can move. We think that the demand environment is there. We need to continue to think about, how do we adjust prices to incomes? They've gotten out of whack. Even in a market like Texas that is more affordable, we need to think about that product. We need to think about those pricing. And if that's not going to work for one reason or another, or if that's not the buyer that you're working towards, we also have to think, what is compelling enough? What kind of product, what kind of home, what kind of location, what kind of amenities are compelling enough that make someone want to resell an existing home and come into the market and buy one of our new homes? So with that, I have 2 minutes to spare, so we got lots of time for questions, so please ask questions if you have them. Thank you for being here. Okay, so we have roaming mics, and if we don't have questions, I have a whole list of frequently asked questions in my head that I can ask myself. So I'm happy to do that. Excellent. I'm going to be careful what I wish for if this is a hard question.
No, just as an overall question. Here in Texas, they will pass some sort of property tax relief eventually. How do you see that possibly impacting the housing significantly? Not really much at all? I mean, what's your opinion on that?
I think before the relief, and this is something that we're seeing in other markets as well, it is probably one of the biggest risks that I didn't talk about as it relates to the local dynamics. So I would say, if it's a scale of 1 to 10 before any kind of relief, how big of a concern? I'd probably say 6.5. So it's something you can't ignore. It's one of the risks that we would watch. But if there is some kind of relief, I think that would be the step in the right direction. But it's property taxes, and it's also insurance fees and costs too that we're watching. So I think those are kind of the extra factors outside of just basic supply and demand that could push things out of whack. Up here.
Yes, question. Historically, one of the things that's really benefited Texas, all of our markets, is that our affordability of housing in Texas compared to other parts of the country is so attractive. Obviously, we attract lots of relocation,
Yep.
relo folks. How is that changing with rising prices in Texas? Do we still have the same level of affordability advantage, or is that being reduced by the demand and the prices we're seeing here in Texas?
Yep, great question. I think it depends on the market that you're talking about. So I think Austin has lost some of that appeal. I think PBS NewsHour just did, I was watching it this morning, a big story on Austin about how this was such a great place that you could go to Nashville or Austin if you wanted to have a music career, and then that used to work and now it doesn't, and does that limit growth? And if it does limit growth, maybe it's limiting growth within the city core, but maybe that means people move further out, but as they're moving further out, that's pushing prices up too, so it becomes a bit of a challenge. I think Austin's going to face that as a severe headwind, and just the constant perception of just how bad it's gotten. And I've even looked, I grew up in Ohio, but I live now in California, and when I look at prices in Austin, I'm even shocked. I'm like, what? So there is that, but I've spent a lot of time in San Antonio and in Houston, and I think from a relative affordability point of view, those markets still have that advantage over many other markets, especially, and I would say particularly from Houston's point of view, they have the labor market to support some of that growth as well. So I think that has the good combination of both of those. San Antonio, I think, is diversifying, and it has some steady employment bases, but I don't think it has as many attractive employment bases as you would say maybe Austin has or Houston has. So still the advantage. I will say for people that are looking, they may say, I thought it was going to be Texas, but Texas has gone up so much that maybe I'm going to look Oklahoma, or maybe I'm going to look at other parts of the Southeast. Parts of Florida still a little bit more affordable in some cases. But the last thing I'll say on it is I didn't show here, but I often present on the share of homes, new homes that are under 300,000. And across the top markets, the top two are in Texas. So I think that still speaks volumes to people wanting to come here, and that there is still that attainable housing opportunity, but it has shifted. Thank you. All right, what else? We got 6 minutes. You don't need to be shy. Anything? Oh, okay, great.
Hey, I just wanted to ask what your thoughts are. You mentioned how government services and land are some of the top costs. How do you think the shot clock bill will affect the government services portion?
That one, you'll have to give me a little bit more detail on that bill.
Basically, it requires building departments whenever they get a permit, they have like 15 days, I think, in order to approve or deny. And if they don't, they have to give it to a third-party inspection service.
That's huge. Really huge. I would say I was just to give you context on a national level, I was in Seattle recently, and they said permitting is taking 8 months now. That doesn't work. That doesn't work when you're trying to time the market. That doesn't work. And I know that that's way more extreme than what's happening here. But I'll tell you, too, that I was talking to a reporter from the Wall Street Journal this week, and they were calling to talk about Texas and kind of the Californication of Texas and how it has become more difficult with regulation, not as Texas as it was been, where it was kind of traditionally this was the market of, oh, this is so much easier to get things approved and to get things moving along. But then because there's been so much growth and not enough hiring, and what I constantly hear is, oh, because all the government workers are working from home, everything has slowed down, that increased demand. I think the shot clock bill would make a huge improvement. And it just helps with trying to time when do you want to bring the homes to market, when are you going to be able to bring the homes to the market, and then especially combined with the improved cycle times. That's a huge factor. All right. I'll say going once, Oh, yay. See how excited I get when you get a question? You just got to ask.
Thank you, Allie, for being here. This has been great. You're known and talk a lot about millennials. What about the generations after? Are you starting to identify and evaluate?
Yes. And if anyone's here from Houston, Houston is the number 2, Houston is the number 2 market that we've identified as the biggest growth opportunity for Gen Z. And so Gen Z would be the group after millennials. And there's a lot of different ways to define them, but we generally say 20, 21, 22-ish is going to be that high end of that group. They went from 0% of the market, excuse me if I forget the date slightly, but I think in 2017 they were 0% of the market. Where they are today, they're either 7 or 9% of the market. So it's one of those things where it was kind of like millennials. We were like, when are they going to buy? Well, they already are. And now as you see Gen Z, like pretty young folks, are participating in today's housing market as well. So it's already happening. It is a smaller group than the millennials in sheer volume, but like I said, for Houston, we know that that has, among the major markets, the second youngest population. Salt Lake City's the youngest, Houston would be the second youngest. What we know from consumer research is, I hope that it doesn't go down this path like we did for the millennials, that millennials never want to live, they want to buy a home, they want to live urban, they're never going to live suburban. I think the millennials proved that that's not the case. I think the Gen Z will prove that that's not the case as well. I think the nesting component, and once you have kids and once you're ready to settle down, the focus on amenities for the kids and the focus on the schools becomes really important. But we've seen no evidence whatsoever that Gen Z do not want to become home buyers. We know that they do, but similar to the millennials, which I would say would be the next youngest group, their biggest concern is, how do I afford it? Because they haven't been able, at least the millennials had the chance to buy it at 3% interest rates. That wasn't really a great option for the Gen Zs because they were too young. But an important thing for anyone in marketing is the Gen Z saying, where do I even start? I just don't even know what to do. And I think probably everyone at that age was a little bit confused, but you think about where do you reach this group? They're so active on TikTok. You can make videos, you can help explain what's a good way to get into, what do you need to do, what needs to happen with credit score. I think there's so much education that can happen, and I think it's an easier group to reach than maybe some of the prior generations when it comes to accessibility. All right, 1 minute. 1 minute, and Josh gets the last question. I believe, unless someone else had a question.
I feel so honored.
Yeah, right?
So you
As a sponsor.
On that same vein, you mentioned earlier that boomers have taken over since 2020 as the, when do you see that switching back to maybe millennials, or is it the Gen Z that are going to kind of come up next, or what's your forecast on, does that stay static with the boomers?
Really good question. So I do not think Gen Z will become the next, it may still be kind of push and pull from the millennials and the boomers. I don't think it'll be Gen Z for a good while, probably 5 to 10 years until we're saying that they're the dominant buyer in the market. If I had to guess, if interest rates stay about where they are or stay in the 6s, I think we may see another year where boomers are the dominant driver. They're just not as sensitive for all the reasons that we highlighted. If you think back to, I kind of alluded to this, but what we've been seeing in our kind of on the ground research, but also in some hard data, is you have so many of the millennials that bought a 1,300 or 1,500 square foot home before the pandemic, and then now that house doesn't work for them anymore, and some of them were able to move up. But what we're seeing is that people that have locked in a 4%, if we do see market interest rates come down to 5, or if builders can buy it to 5 or even lower, those buyers have been willing to sell their home and move and been able to contribute to that supply. So I think millennials will ultimately overtake boomers again, but it may take more shifts in the market before we see that happen soon. All right. I think that is it for now. So I'll be at the next booth to answer any more questions or just stop by and say hello. Thank you guys for being here. Thanks so much to the Sunbelt Builders Show. Hope you enjoyed.